Hello, everyone. My name is Zulfiqar, and welcome to another episode of Income Investors. With me today is John Whitefoot with another exciting income pick. If you want to read more about what John writes on a regular basis, you can head to incomeinvestors.com. You can find the link to the website in the description below. Real estate investment trusts, or REITs for short, have taken a hit during this high interest rate environment. And that's because higher rates increase the cost of capital and cut into earnings. But with rate cuts expected to begin in coming months, now is a good time to consider an overlooked and, according to Wall Street analysts, widely undervalued Medical Properties Trust Inc., traded on New York Stock Exchange under symbol MPW. John?
Yeah, thanks, Mo. The Global Healthcare REIT, Medical Properties Trust, is the second largest non-government owner of hospitals in the world. Now, the company has total assets of approximately $17.4 billion, including $11.3 billion of general acute facilities, $2.4 billion of behavioral health facilities, and $1.7 billion of post-acute facilities. Now, as of March 31st, 2024, which is the most recent data we have, Medical Property Trust portfolio included 4 properties and approximately 43,000 licensed beds leased to or mortgaged by 53 hospitals operating companies across the United States, as well as the United Kingdom, Switzerland, Germany, Spain, Italy, and I think Portugal. The portfolio is always changing. In the first quarter, completed the sale of 5 hospitals in California and New Jersey for $350 million and commenced rents at development properties in Texas and Spain. And this past April, it also sold a 75% stake in 5 Utah hospitals for total proceeds of $1.1 billion.
John, I have to ask this. Is there a reason for this liquidation? I see that Medical Properties has run into a little trouble with one of his biggest clients.
Yeah. For-profit healthcare doesn't always lead to profits, despite having one of the best underwriting practices in the industry. Even Medical Properties Trust experiences the odd bump in the road. Past May, one of its operators, Steward Healthcare, filed for bankruptcy protection and put all of its hospitals, U.S. hospitals, up for sale in an effort to address its $9 billion in debt. Now, due to financial strain, Steward has fallen behind in paying its rent to Medical Properties. I believe the hospital system owes Medical Properties nearly $1 billion. No bankruptcy judge will decide how much of that Medical Properties will actually get.
Did the bankruptcy filing have to do with owing Medical Properties so much money?
Now, before you go thinking that Medical Properties is a callous landlord shutting down hospitals because of back rent, it's important to note that rent payments under Medical Properties hospital leases represents only a small percentage, single digits actually, of a hospital's total sustainable reimbursement revenue. Now, Steward actually declared in its filings with the U.S. Bankruptcy Court that its ballooning debt was a result of patient mix and lagging reimbursements, declining patient visits and revenue, and a sharp increase in labor costs. In its Chapter 11 filing, at no point does it cite rent as a core contributing factor for its eroding earnings and liquidity. Now, Steward has said that it's looking for third-party capital that will be used in part to pay for its outstanding debt to Medical Properties. But of course, there's no guarantee that Steward will be able to successfully execute on its plan, or that Medical Properties will recover all of its deferred rent.
This must have negatively impacted the company's first quarter results.
Yeah, right now, Medical Properties is a bit of a work in progress, in large part because of uncertainty surrounding Steward's filing for Chapter 11 bankruptcy. Yeah, in the first quarter, the company reported a net loss of $736 million, or a loss of $1.23 per share, compared to net income of $33 million, or 5 cents per share in the same period last year. Now, the net loss includes approximately $693 million, or a loss of $1.16 per share of impairments, primarily non-real estate adjustments related to Steward Healthcare Systems, which Medical Properties has said it is committed to pursuing. Now, normalized funds from operations, and that's a term used by REITs to define cash flow from operations and used to pay for dividends, was $142 million, or 24 cents per share, and that was down expectedly from $222 million, or 37 cents per share in the same period last year. The lower normalized funds from operation was mainly a result of the decrease in revenue from Steward. As previously noted, during the first quarter, Medical Properties began collecting rent at development properties in Texas and Spain, and subsequent to the end of the first quarter, it completed the sale of 5 hospitals in California and New Jersey and sold a 75% interest in 5 Utah hospitals. These actions are expected to help the company exceed its initial target of $2 billion in liquidity in transactions in 2024.
And this company was able to maintain a quarterly dividend of 15 cents per share.
Yeah, despite troubles with Steward Healthcare, medical properties, other hospitals are generating cash, which is helping fuel its dividend. In May, it paid out a quarterly cash dividend of 15 cents per common share, or 60 cents per share on an annual basis, for a forward yield of 12.74%.
Lastly, MP stock has a triple-digit upside potential.
Medical properties' big 12.7% yield is primarily a result of companies' deteriorating share price, which, as of this recording, is down around 42% over the last 12 months. Now, that said, MPW stock is showing signs of life, 60% alone since February. Now, that could be just the beginning, too. Medical property stock has taken a hit due to financial struggles with Steward Healthcare. Higher interest rates certainly haven't helped either. To beef up its balance sheet, Medical Properties has sold off certain properties. It also slashed its dividend by 50%. Now, on the plus side, thanks to its improved liquidity, it's been able to refinance some of its debt. It's also well on its way to exceeding its initial target of $2 billion in liquidity this year. These actions have helped to energize sentiment on Wall Street, with analysts expecting Medical Properties to report a full year 2024 loss of 66 cents per share before climbing to earnings of 42 cents per share in 2025. This has also juiced share price expectations, with analysts providing a 12-month average forecast of $5.86 per share and a high estimate of $10 per share.
John, thank you so much for your insights. Just to recap, Medical Properties Trust, Inc. is a REIT with a strong balance sheet and growing international portfolio. Unfortunately, its share price has taken a big hit due to one of its clients filing for bankruptcy. It also cut its dividend to shore up cash, but because of its strong normalized funds from operation generation, it seemed unlikely that additional dividend cuts are on the table. Most importantly, it has improved its financial health and refinanced its debt. It is also looking to recoup some of millions of dollars it owed to Steward Health. This hasn't gone unnoticed, with conservative Wall Street analysts providing strong guidance over the next year. On top of that, it has strong institutional ownership, with 691 institutions holding 74.9% of Medical Properties' outstanding shares. The two biggest institutional holders are BlackRock with a 15.7% stake and the Vanguard Group with 15.5% interest. That's it for today, and make sure to go to incomeinvestors.com now to get our free special report on 3 income stocks to own today. One of those stocks currently has a dividend yield of 12.7%. You can find the link to incomeinvestors.com in the description below. We'll be back with more income picks soon, so stay tuned. And in the meantime, don't forget to like this video and subscribe to our channel. Goodbye for now.